The original promise of YouTube was built on a complete rejection of traditional television. Instead of focus groups and network executives, you had a direct, unmediated line to an independent creator. You watched because you trusted them. But recently, you've probably noticed a shift in the channels you subscribe to. The upload schedule is suddenly incredibly aggressive. The original host you actually subscribed for is barely on screen anymore, and the videos themselves feel hollow. The reason behind this shift is a $4 billion wave of private equity money quietly moving into the platform to acquire established creators. A platform built entirely on authentic, independent voices has been converted into a high-yield asset class for Wall Street fund managers. If a creator accepts a few $100s to mention a VPN or a mattress, the Federal Trade Commission requires them to put a clear, unavoidable disclaimer right in the video. But there is a massive blind spot in those sound regulations. If a Wall Street fund buys the creator's entire company and takes over the production, that creator is under zero legal obligation to tell you they sold out. Because the law doesn't demand transparency for macro acquisitions, millions of viewers are unknowingly watching carefully engineered corporate assets disguised as relatable internet personalities. Private equity loves a bargain, and compared to traditional industries, YouTube channels are incredibly cheap. An independent channel usually sells for roughly 3 to 5 times its annual earnings. An investment firm buys a channel at baseline valuation. They buy 9 more, grouping them under one corporate umbrella to share teams, a roll-up. By bundling these into a portfolio, the parent valuation shoots up 20 times its earnings. This is multiple arbitrage. The firm doesn't have to make the videos better, get more views, or improve audience experience. They generate massive wealth simply by restructuring the ownership on paper. But there is a massive financial liability baked into this business model, known as key man risk. If a purchased channel relies entirely on one human being, the entire investment goes to zero if that founder gets sick, if they burn out, or decide to walk away. To protect capital, the new corporate owners systematically engineer the original creator out of the production. They hire a rotating cast of cheaper, interchangeable hosts, slowly phasing them into the upload schedule. Replacing the founder successfully protects the firm's downside risk. However, it completely destroys the deep parasocial loyalty that made the channel valuable to begin with. Private equity funds operate on a strict timeline. Investors expect returns within 5 to 7 years. As that deadline approaches, the firm has to aggressively maximize short-term profits to make the portfolio look appealing to the next buyer. This financial pressure creates what audiences recognize as slop. Passion projects are canceled because they are too risky. Creative directors are replaced by AI tools that approve cheap, brand-safe scripts. The channel is forced to double or triple its weekly upload quota. When you notice the channel's quality falling off a cliff, you aren't witnessing a creative slump. You are watching a deliberate mathematical equation designed to optimize art for a corporate exit. Wall Street is certainly making a fortune off multiple arbitrage, but the ad revenue is a secondary prize. The actual asset private equity is hoarding is raw audience trust. We abandoned our trust in banks after 2008, and faith in mainstream news networks has been eroding for decades. That trust didn't vanish. It transferred directly to individual internet creators. When a small group of investment firms covertly buys up the digital influencer ecosystem, they quietly acquire the power to shape consumer habits, cultural norms, and societal beliefs without ever showing their face to the audience. We saw the scale of this power during the 2024 presidential election. Long-form interviews with independent creators like Joe Rogan hold tens of millions of views in hours, directly influencing voter behavior at a level traditional media couldn't touch. Private equity firms already dictate which topics are too risky for advertisers. It is a small step from sanitizing content for profit to steering editorial direction toward candidates who promise to protect the firm's other multi-billion-dollar investments in healthcare or logistics. The race to buy up the last remnants of public trust is no longer limited to private equity. OpenAI's recent $100 million acquisition of a major independent tech stream shows that tech giants are also moving to own the voices we rely on to tell us what is true. The declining quality of your feed is only the first symptom of this takeover. The second is a media landscape where every trusted voice has an owner who benefits from what they tell you or what they choose to ignore.